welcome to Cafe Mutual YouTube channel. Friends, yields on money market funds have improved. In fact, money market funds have been doing good among all debt categories over the past 1 year. So, what is driving this momentum and what's the short term outlook on money market funds? To answer these pertinent questions, today we have with us Anju Chhajer, Senior Fund Manager, Nippon India Mutual Fund. Anju has over 16 years of experience in fund management. Good evening, Anju.
Good evening.
So, Anju, my first question to you is that what would be the impact of inclusion of Indian GSEC in JP Morgan Emerging Market Index on Indian debt market? And which categories of fund will benefit from this move?
As we are all aware, any pricing of any asset is determined by demand supply. So what is this inclusion doing? It is adding 20 to 22 billion US dollar of demand from of government securities in our markets. So naturally, if demand is increasing, then it will have a positive impact on the pricing of the asset. That's a broad this thing. So not only this, there are other indices also who are considering inclusion going forward. So all this thing over the 3-year period, the demand for Indian G6 will go up by 50 billion is broadly estimated. So in that kind of an environment, this has a very much a positive impact on our government securities market, and a good amount of demand gets created. At the end of the day, demand is the biggest driver of pricing. So if GSEC is, as we all know, is the base curve for us. If GSEC pricing is softened, it automatically improves the pricing of all the other curves across corporate bonds and SDLs and everything. Over and above this, all this will add overall liquidity in the system, and will be positive across for the economy as a whole also. Okay. That is the broad impact.
Okay. And which category of fund should investors look at buying?
See, category of fund people should invest depending on their risk profile and their investment horizon. That is the basic thing there. And over and above that, this will help naturally the longer duration funds quite a bit, because the majority of the demand for GSEC will come at the long end. And with so depending on the interest rate view, one can look to invest in longer end GSEC, because most of these flows will come under long end GSEC. But this is only one of the factors determining the pricing of the asset. Okay. There are many more factors that will guide us the pricing of the asset.
Yeah, okay. So Anju, AMFI data shows that majority of short-term funds did not beat their benchmark. So what are the reasons for this according to you?
You must understand there are 2-3 factors involved when we are doing this exercise of comparing with benchmark. One is the benchmark itself. If you look at the benchmark itself, it is not replicable. This is not like a benchmark of equity indices where you can buy those particular share and we replicate the indices or near to the indices. We as fund managers, even if we want to or try to replicate, most of the time the indices are very much different, and the restrictions applicable as per SEBI at times are not applicable on the benchmark indices. That is also another constraint. So first thing is it is very difficult to replicate the benchmark. Even if we are able to replicate or not replicate the benchmark, to create a beta over and above the expense. See, most of the debt funds of shorter end of the curve, if you see, it has an expense ratio of 20 to 40 basis points. When I generate an additional return of 20 to 40 basis points, then only my fund will beat the benchmark. To create that beta, additional beta on a consistent basis in a commoditized product, because this segment of the market is more commoditized than anything else.
Right.
Is very difficult, because 80% of the returns, as we are aware, comes from the carry of the product. So if you compare gross of expenses, most of the times you will see we have beaten the indices. But net of expense, naturally there is you would see underperformance figure. Say for example, I'll give you a very simple example: liquid fund. Liquid fund most of the liquid funds have an expense ratio of 10 to 20 basis. To generate additional 20 basis point in a liquid fund which is so commoditized as a product is almost impossible. And this expense differential is what you will see most of the time. The difference is between the indices and the benchmark indices and the portfolio. Third factor is we have to keep liquidity in the fund, which the indexes don't need to. And there's a lot of inflow and outflow in these funds, which is much higher than other debt products. So all the shorter end products has a lot of subscription redemption, which is very seasonal and very volatile. EM is very volatile. So our liquidity requirements are much higher than the indices, which most of the indices have, portfolios have. So all these factors results in the factor that we are not able to beat the net of return, net of expenses. We are not able to beat the benchmarks.
So, Anju, liquid funds and overnight funds are good for cash management or to meet short-term expenses. But where does money market fit into investors' portfolio, and what's the utility of money market funds according to you?
Money market funds are very useful. Liquid and overnight gives you above some savings rate. You can compare with savings bank account. But money market fund, most of the times we have seen most of the investors remain invested for 1 month to 2 month period. If you are invested for a 1 to 2 month period or 1 to 3 month period, money market fund is a better opportunity, is better fund to be invested in, because most there liquid fund, as we know, we have a constraint of investing in 3 month assets, and the average maturity is 40-45 days. Whereas money market funds average maturity is 150 to 200 days. So there you will be able to generate better returns. Though there is small risk, but over a 3 month period, most of the risk gets mitigated. And generally, if you historically look at the performance of a money market fund, it generally beats a liquid fund by 20 to 40 basis point, depending on the steepness in the curve. So money market fund is a risk reward wise, it is a very good option which investors should look at if their investment horizon is not 7-15 days but 30 to 90 days.
Great. So, Anju, value research data shows that Nippon India Money Market Fund has delivered over 7.26% return in the last 1 year. So, what has contributed to this performance?
As I said, 80% of the returns for the short end segment is contributed by the carry of the asset. So it is a portfolio carry that gives you the 80% of the returns. 20% is where we can shuffle the portfolio and generate that additional beta. So broadly, if you see what is our logic is simple. Discipline. We have a particular discipline that we follow. Based on that, we have a fund casing format which we have. Based on that, we continue to invest on those constraints. And with that constraint and duration management, our logic is maintain good quality portfolio, because ultimately it's a fund where liquidity is most important factor. Maintain a good quality portfolio with some focus of 15 to 20 to 25% of the portfolio would be focusing on the carry, and hence generate good returns over a 3 to 6 month period.
Okay. So, Anju, one specific problem that MFDs have is selecting a short-term fund, especially like money market fund, because it is very difficult to shortlist one fund because of the marginal difference in performance. So, in such a scenario, how can MFDs shortlist money market funds for their clients?
Asset quality is a big factor. One can look at the asset quality and the consistency of the return. These are two big things. And the third would be your philosophy. If you there is a philosophy which every mutual fund follows. Based on that, you have to understand the philosophy in which each fund is doing. So, if your asset quality is good, you are consistent in your performance. I know the differential created by different fund managers is very relatively, as I said, these are commoditized products to some extent, because we all are in the same market universe, think similarly. So most of the funds deliver similar returns more often than bad. And also because 80% of the returns are coming from the carry. So naturally, the differential that can be created is much lesser than in a longer duration funds. So what you have to focus on is the consistency of returns and the asset quality of the portfolio. These are the two factors that are more important than anything else.
So one last question, Anju. Why should MFDs recommend Nippon India money market funds to their client?
We have a, not only for money market fund, for any fund, we have our thing is discipline. We have a very strict fund casing rules within which we operate. We don't go and do, we are very clearly laying out how much we can take AAA, what would be our down AAA component. Everything is well defined and monitored on systems by our risk team. Then we have the SEBI, whatever it mandates per issuer limits, our per issuer limits are much lower than that. So we have a lot of constraints which we have built in the portfolio to ensure the risk management for the portfolio like money market, which is required very highly because high liquidity is to be maintained and asset quality has to be maintained. That is taken under the control and is within the limitations defined by the system by us. So considering that and consistency of our performance, above all, if you would look at our performance for last 3 years, any 3-month performance you can look at, the consistency of our performance is very high, and that is what is our selling point.
Great, Anju. So with that, we have come to an end to this interesting session. Thank you so much for such an insightful discussion.
Thank you. Thank you.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.